Can you guys hear me okay? Microphone check, microphone check. All right, so, huh? No, what? All right, so what we're going to be talking about today is what's the title of this? How to escape the broke mindset. All right, so it's really important with real estate investing, business in general, success, to understand that nothing is handed to you, right? Like if you guys are wanting to go out there and start your own business, whatever it is, real estate or not, it's really important that you understand that no one's going to hand you anything. The business world is a pretty ruthless environment. It's a pretty cutthroat world out there. And, a lot of people are not going to be rooting for your success, and a lot of people are not going to just hand you anything. So, the broke versus rich mentality is something that you really need to understand and comprehend on multiple levels. Today, we're not going to be able to dive into all of it. It'd probably take hours and hours and hours to fully cover this concept. But I do want to talk about a few things today in regards to escaping the broke mentality. First and foremost is, when investing in real estate and making investments, there's a ton of risk that's involved. You can minimize this risk in many different ways. First and foremost, by only buying good deals. But there's definitely risk involved. However, there's also risk involved with not taking any risks at all. I mean, there's risk involved in not investing your money. It means that your money's not going to grow. You may not have passive income set up. You're not going to multiply what you got. And there's a lot of risk involved in actually not taking risks because it means you're not going to grow. And if you ask me, that is a lot more risky than taking the risk to set yourself up for future success. So there's a few things I want to talk about today. First and foremost, not having a victim mentality. I think this is crucial in business. Second, tell me what y'all think about this new setup here. It's kind of dark in my opinion, but I want y'all's. Oops. All right. Second one is debt. I think a lot of people are scared of debt and taking on good debt, and I think that is mindset that needs to be shifted. Third is investing in yourself. Investing in yourself is really important and something that I want to dive into today. And then taking risks. All right. So first, the victim mentality, just business in general. You're going to need this. You're going to want this prevalent in your real estate business, but it doesn't matter what type of business you're in. Having a victim mentality is going to fail you and cause you a ton of problems that don't need to exist. So what is a victim mentality? Victim mentality is where, everything's always happening to me, poor me, why is this happening to me? Why, this property was way worse than, the real estate broker or seller told me it was. The property manager is not doing a good job keeping my maintenance request or my maintenance costs down. My contractor screwed me over. Whatever else there is, it's basically getting rid of the fact that you're a victim and all these things are happening to you, and the fact that you are not in control of the outcomes that arise from your business and from your real estate investing. Because the truth of the matter is that there are things that are out of your control, and there are things that are going to happen that are out of your control. But owning these things, owning your business, owning all the results and outcomes of your business, um, require you to notice these things, take preventative measures, and anything that happens is always going to come back and it's going to be your fault. For example, here, with staff here, with agents here, with anything that goes on at TRE, it doesn't matter if it's good or bad, or if me or Matt are directly involved or not, it always falls back on us if something goes wrong. Sure, when something goes right and things are going well and there's good outcomes, it's a good thing. But when someone does something that we knew nothing about and we're not in control of, and it turns out to be a negative thing, it falls back on us and it's our fault, ultimately. This is our business. We are up here. Every decision that happens falls back on us. We take full responsibility for everything that happens here at TRE. And whether that's good or bad, it's just the way that it is. And we, as the business owners here, can do things and put things in place and check things and check on things and, take daily action to prevent negative things from happening. However, there's just stuff that's out of our control. But at the end of the day, we take full responsibility for it. And if something negative happens, we need to accept the fact that ultimately, whatever it is or whoever did something, it's ultimately our fault and our responsibility. And not operating from a victim mentality allows us to operate from a place of responsibility and accountability, and allows us to push things forward instead of things always happening to us, or the world's out to get us and all these bad things are happening to me. The victim mentality will always fail you in business, no matter what. All right, so now that we're off of that one, debt. So for the longest time, I operated from a cash basis. I always had cash. I always bought things cash. Never did anything with credit. Never got a loan for anything. There was no need to necessarily, and I didn't see the benefit of going into debt for something that I could just pay cash for. I never wanted to owe anybody money. I was operating in a different business than I am today. And I just liked having everything paid for. And if anything went wrong, it was my fault. And I was always going to be able to, accept any sort of financial responsibility for what happened. Now, getting into real estate investing, looking back at that, allows me to kind of see, how flawed that mindset was. Especially with real estate investing, debt is a really good thing, and debt has provided us, much more benefits than any sort of negative that it's ever brought. The only negative really is extra costs that are involved, right? Origination points, appraisals, etc., interest being paid. However, the benefits that are involved with debt are the fact that the tenants are actually paying these debt payments, right? Like, I'm not making these debt payments out of pocket unless the property is vacant, which it shouldn't be. But there is instances where it is. However, majority of these debt payments are made by the tenants. We've got debt on the properties that is covered by the income, and therefore me and Matt are not paying any debt payments towards our properties. The tenants are, and that is the purpose of the asset, right? And that's why I said you can really minimize your risk by buying good deals, because a good deal should have enough income coming in to support not only the operating expenses of management, taxes, insurance, maintenance, repairs, utilities, all these things, but it should also be able to support the debt payments that you have. Now, right now is a really interesting time, with interest rates being where they're at compared to where they have been. And this is presenting a really unique opportunity to get some deals much cheaper than you normally otherwise would have, a year and a half, 2, 3 years ago. 2, 3 years ago, interest rates were down at 2.5%, 3%, especially right when the virus plagued the entire world. Interest rates dropped down to, I think, the lowest they've ever been. And so when that happened, when interest rates and debt were basically free, what that allowed real estate investors to do was to pay higher prices for real estate investments and or homeowners too, due to the fact that the money was basically free. Today, with interest rates at 7.5%, 8%, or wherever they're at exactly, depending on what type of loan you're getting, it's much harder to pay those prices for real estate due to the fact that the debt costs so much more. So right now is a really unique opportunity, right? 2, 3 years ago, if properties were selling at a 4, 5 cap, today they basically have to sell at a 8, 9, 10 cap in order for the investment to be able to service the debt, which is a very interesting concept, because that means that all these properties, if they have the same NOI that they did 2, 3 years ago, which hopefully they do, if not greater NOI, they have to sell at 50% below what the property would have sold for 2, 3 years ago, due to the fact that debt costs so much more now. Now, sellers have not fully come to terms with this new real estate market, and they're still trying to sell at 5 caps, 6 caps, 4 caps, which can work if the seller is willing to structure some seller financing terms with debt that can be serviced via the NOI. But with debt at 8%, 9%, 10%, unless someone comes and buys this property cash, and or puts 50% down, it's unlikely that, going and putting 25, 30% down on a property, getting one of those interest rates, you're going to be able to make your mortgage payments. Therefore, not being able to buy the property, not being able to get a loan on the property, and the seller not being able to sell the property, at least at the price that they want to sell at. And so sellers need to fully understand this reality and this concept, which I don't think they have come to terms with just yet. But they will if they haven't already, and or they have to figure out some sort of creative way to get a deal done in order for the debt to be serviced, because it can't be, buying it at a 4 cap and having a 8% interest rate. It's just not possible unless, like I said, you buy the property cash and or put down 50+% to buy it, which most real estate investors don't want to do. Most real estate investors want to utilize full leverage. It's one of the greatest benefits of buying real estate, is being able to utilize leverage to buy the deal, to buy the asset, and have this leverage, this debt, covered by the net operating income that's coming in from the property. So debt is a good thing. You should use debt. It's one of the greatest benefits that real estate has to provide, is being able to utilize leverage on it. And I heard someone say I think it was Warren Buffett said that, I was listening to him talk at the Berkshire shareholders, conference or meeting, and he was saying that real estate is basically just an average investment if you're not using debt. When you are using debt, it is a fantastic asset to buy. It's a fantastic investment, and it provides above average returns. But if you're buying them cash, it's not really providing the greatest returns that you could be getting if you utilize debt. Do we have any questions so far? Where are we at? We're on Instagram, Facebook, YouTube, LinkedIn. Now, I've demonstrated this concept before, but I want to demonstrate it again. Can we see this full thing here? All right. So let's say that property purchase price of a property is $1 million. We're going to use simple math. let's say that the NOI on the property equals, let's call it $80,000. NOI is the net operating income. The net operating income is the difference between your income minus your operating expenses, gives you net operating income. Now, if you bought this property cash, we went over this not too long ago, but we're going to do it again. Cash, debt. If you bought this property cash, it's going to give you an 8% return. It's an 8 cap. 80,000 based on the $1 million you put in is 8%. That's the return that you're going to get. Now, for example, let's say I got Paulie texting me. We may get on a call with that seller from last week. But now with debt, let's say that you put down, let's just call it $300,000 to buy this property. Let's say right now, because an 8 cap, if you were to go get a loan for 7%, 7.5% right now, you might cash flow a little bit, but your cash on cash return is going to be very small. But let's say right now you were able to go and convince this seller to seller finance it to you. So you put down, let's call it $250,000, 25% of the purchase price. Your loan balance is going to be $750,000. And let's say that you convinced this seller to sell it to you with seller financing. You'll give them $250 today. You want to loan for at least 5 to 10 years, and you're willing to do, let's just call it 6%. 6% interest-only loan, which means that your debt payments are going to be $45,000 a year. Your annual debt is going to be $45K a year. So your cash flow, 80,000 NOI minus your 45,000 in debt, puts you at $35,000 a year in cash flow, correct? Is that correct, Kat? Gia? All right, so now we're going to figure out what your return is utilizing the debt here and structuring a deal with debt. So for $35,000, right, difference between NOI minus your annual debt payments of $45K gives you cash flow of $35,000. We're going to divide that by your cash invested of $250,000, and this is going to give you the return that you're making, right? You put down $250,000, you get $35,000 back every year, and now your return is 14%, right? It's much greater than the 8% that you got paying cash for it. And you can do this. Now you can go do this 4 other times, right? Because you got $250. Let's say you have $1 million cash. Sure, you can buy it cash, get 8%, $80,000 worth of NOI, or you can go out and you can put $250,000 down on 4 different properties, and you'll be able to gain almost double the return that you would get buying the property cash. Except you're going to be able to do that almost 8x, right? Because you're receiving 8% on your money here, $80,000. Here, you're going to be able to receive a lot more. And you can do it 4 different times. And not only are you getting more cash flow utilizing the debt, but you're able to buy 4 properties. You're able to utilize 4 properties for depreciation. You're able to utilize 4 properties for the appreciation that you're going to get. And when you raise the NOI, your percentages are just going to get better. They will here as well, but it's much better utilizing the debt. And then after 5 years, 10 years, when this debt comes up for its balloon payment, you need to pay it off. You're going to be able to refinance it, hopefully, at a good interest rate. And maybe if interest rates drop back down to 3%, 4%, you could refinance it then too if there's no prepayment penalty. You could refinance it, get your money back out, get better debt payments, and have your cash flow increase even more. And so this is the difference between buying cash and utilizing good debt and structuring good deals with debt when buying real estate. It makes the returns so much more better, almost double in this case. Any questions at all? All right. So debt. You need to get rid of this victim mentality. This is never going to serve you. All right? Things are not happening to you. You need to take control of your business. You need to take control of your life. You need to stop, blaming others for the problems that are going on, and you need to take full responsibility and for whatever any outcome comes, right? You are in control of your life and your business. Get rid of the victim mentality. Debt is good. You need to start understanding how debt works. You need to start building relationships with lenders. You need to start learning how to structure seller finance deals. If you're not using debt to buy your real estate assets, it's really just a okay or average investment. When you have good debt on the deals, it makes it that much better, and it is an above average investment. All right, investing in yourself. A lot of people are I think a lot of people are afraid to, invest in themselves, whether it's a coaching program, whether it's a book, whether it's a conference, a seminar, some course, investing in yourself by taking risks, right? View this as investing in yourself. You need to start investing in yourself, investing in your education, investing in experiences in your business, invest in trying things out. Because if you don't, you're not going to grow. And, it'll take much longer to accomplish the things that you want to accomplish if you're not investing in yourself and your business. And when I say investing in yourself and or your business, I mean, here's a example of investing in your business. And this all kind of falls within taking risks. But investing in your business, if you're not sure if you want to hire somebody, if you're not sure if you want to outsource something, if you're not sure if you want to pour this money into advertising and marketing, investing in a website, investing in personnel, investing in infrastructure, investing in software and systems. You need to constantly invest in your business and in yourself. Investing in employees' education. Here at TRE, not everybody does it, but people have the opportunity to, further their education, and we'll pay for it for them to go to school, take a course, take a class. We want everybody to get better. We want everyone to, be invested in their position and what they're learning and getting better and learning new things. So, you need to learn how to do this, not just for yourself, but also for your company and for your people. A lot of times when we're making decisions and taking risks here, especially within our business, we are not exactly sure what the outcome is going to be, right? We can do our best to gauge, we can do our best to prepare, we can do our best to plan, but we don't necessarily know exactly what's going to happen if we put X here, what it spits out Y over here. We have to take these risks, these calculated risks. We have to invest in the business, and we have to invest in ourselves and in our people. It's really important to put your money here. It's the most important place you can spend your money, is investing in furthering yourself and furthering your business and furthering your people. All right, taking risks. Real estate investing, like I said at the beginning, is there's risk involved. There's risk involved in any sort of investment. You can severely decrease the amount of risk that you might experience when you are investing in real estate and buying good deals with good debt, with good tenants and good locations. and really good assets. But it has a substantial amount of risk if you don't do those things. If you don't follow the entrepreneur method, if you don't follow your deal checklist, if you don't follow, what we talk about in here every single day, there is, the level of risk increases. If you're just guessing and you're getting impatient, and if you're buying with emotion, and if you are, not negotiating the way you should be, and if you're not sticking to your, non-negotiables in the deal flow, and if you're not exploring all exit strategies, and if you're operating with blinders on, there's definitely a good amount of risk, and you potentially could lose money, and a lot of money. But if you are following what we talk about in here every day, if you're following what we talk about here in this book, if you're talking about what we talk about in our webinars and what we teach at the events and what we help everybody with in the entrepreneur community, your risk goes down substantially. I mean, I think one of the greatest benefits of being a part of what we do here is not so much necessarily, how much money we can make together, which is infinite. But, if you're out doing your own thing and you're not really interested in that aspect, we can help save you a tremendous amount of money and help stop you from losing money on bad investments. So there is risk involved, but you can substantially decrease the amount of risk when you do, what we talk about in here every single week. And there's also risk in not taking risk, a tremendous amount of risk in not taking risk. If you're not taking any risk with yourself or your business or real estate or any other investment, your money is going to just lose its value, right? If it's just sitting in a bank account and you think you're going to save your way to retirement, you're not, most likely. And it's just losing value every single day. The more inflation increases, the more the value of your money decreases. And you need it to grow. You need it to start working for you every single day while you sleep. You need the money to be invested into things that you can utilize debt on, that you can get cash flow from, that you can get tax benefits from, and that can start multiplying while you sleep. All right, I need some water. Who's got any questions? How are we doing with audio and video? Instagram, are we good? All right. Let me talk about some things you can do to substantially decrease risk with real estate investing. I'm not able to share my screen here, am I? I'm sure there's a way I can. Can I try and do that? Instagram's not going to be able to see it, but that's okay. Instagram, I'd like to figure out a way to get you guys connected here. That way y'all can see our live streams, aside from just going live in the thing. All right, so I'm going to share my screen real quick for everybody. Let's see how we can do this. Chrome, don't want that. Let's just try this. Kat, tell me how we're doing. Can you see? Microphone check. Am I frozen? I think they can see. There we go. All right, cool. So here's how real estate builds wealth. And this is how we're going to decrease risk with real estate investing. So first and foremost, good. Yeah. It's important to understand the benefits of real estate and why you want to buy it and utilize it as a great investment vehicle for you. So first and foremost, you got appreciation. Now, everybody knows this. Everybody knows that appreciation comes with real estate investing. Everybody who bought a house here in Austin in the 80s paid whatever they did, 20, 30, 40, 50 grand for it. Today it's worth 500, 600, $1 million. I think everybody understands the concept of appreciation, right? And the fact that if you're in a good market and you're buying a good asset, the asset should appreciate over time. Well, yes, that is very true. But when you get appreciation on top of the leverage that you use to buy the asset in a very short amount of time, you can get substantial returns on your money that's been invested. For example, with that thing we did over here, purchase price $1 million. You put down 250 grand to buy it. In 5 years, 4 years, 3 years, if interest rates drop back down below, let's say 5%, and you're buying this at an 8 cap, let's say in 3 to 4 years you can sell this at a 4 cap, and let's just assume that NOI remains the same at 80K. If you're buying this or if you're selling this at a 4 cap versus an 8 cap, in 3 to 4 years from now, the property will be worth $2 million. And when the property is worth $2 million and you sell it for $2 million, you're making $1 million. That's your gain, right? Because purchase price is still $1 million. You still got debt on it of $750, but you're gaining $1 million in gains based on $250,000 that you put down to buy it. You didn't put down $1 million like this guy did, and he's getting an 8 cap. Yeah, and that'd be great. Double your money in 3 to 4 years. But isn't it better to quadruple your money in 3 to 4 years when utilizing good debt? So the appreciation that comes from real estate can be amplified when you're utilizing good debt. Passive income. People are going to pay their rents. You're going to have a property manager who's collecting rents, handling all the operating expenses while you sleep. This does not require you to be an active investor. You absolutely can be, but you can passively invest in real estate, not have to worry about any of the problems, experience all the benefits of leverage, appreciation, depreciation, tax-free income, passive income without having to lift a single finger. All you got to do is invest. Leverage, right? Leverage we just talked about. Debt, depreciation. Depreciation is where this passive income you're getting here, hopefully you're not going to pay any income tax on it due to the fact that you're depreciating the asset that you have. So when you bought this property here for $1 million, you put down $250,000 to buy it, you are going to depreciate the entire asset, not just the $250,000 portion that you invested cash for, but the entire thing. There's an improvement value to the land, and you can depreciate the improvement value of that asset. You can't depreciate the land. And so what that does is it offsets, or it should offset, this $35,000 worth of income that you got. Actually, $80,000 depends on if you bought this cash. You're getting that full NOI, right? Here, you're probably going to be able to write off your interest that you're paying here of $45K. Then you got $35 left over, and your depreciation should wipe that out. And it's just paper. It's just you're not actually losing it, but you're depreciating it. It's an expense, and you're offsetting the income that you get. So that's another benefit. Equity day one, if you're buying right and you're not paying market value for things, you're walking into a return the second you sign the papers and the deed is transferred. Tax-free access to capital. Like I mentioned, in 3 to 4 years, when the property is worth $2 million, you do a cash out refinance, and you get a new loan on the property at a 3.5% interest rate, for example. Your debt payment probably it'd probably be slightly higher than that 45, but the difference between this, what was it, 6%, 6.5% interest only versus 3.5% interest only, even though the amount that you're paying that interest on has increased substantially, your payment's not going to be that much higher, depending on what debt terms you're structured. So you're going to have a new payment, but you're going to get to pull out all this equity and reuse it to buy more real estate and keep that cycle going. Large paycheck to reinvest, just like we said. What do we got? There's many different exit strategies to buy deals, right? And this is how you also decrease the amount of risk that you have when investing in real estate. Is you approach deals from the entrepreneur method and you figure out what is the best strategy here and what is the best way to capitalize on the opportunity. If you, like I mentioned earlier, if you go in there with blinders on, if you're going in there and you're not truly approaching the deal from the entrepreneur method way of analyzing deals and doing deals, the risk is substantially higher. But when you're approaching them with multiple exit strategies, and you could buy and hold, you can structure seller finance, you can buy it sub 2, you can wholesale it, fix and flip it, raise capital for it, just get your commission on it, partner in JV on it. Your risk decreases substantially because you're keeping an open mind to taking it down and doing whatever is best for the deal. You're not locked into it has to work this way or it must, look exactly like this, because a lot of them don't look like that and a lot of them won't work out that way. But you need to keep an open mind and you approach it with multiple exit strategies. You substantially decrease the amount of risk that's involved with real estate investing. The deal requirements: you need opportunity, value, equity, multiple exits, good location, demand from other investors, great cash flow, great financing, great management, great contractors. When you have these deal requirements in place, you're again substantially decreasing the amount of risk that one has when investing in real estate when they don't have these things. If you've got a bad manager in place, risk goes up. If you got bad contractors in place, risk goes up. If you're buying an asset that no other investors want to buy, then risk goes up. If you have negative cash flow, risk goes up. If there's no opportunity, no equity, no multiple exits in a bad location, risk goes up. So you can substantially decrease this risk by having all these things in place, by buying them utilizing the entrepreneur method, and by making sure that you're only buying good deals. Any questions, Kat? How do I end this string or stop this share? All right, there we go. All right, guys, get rid of the victim mentality. Things are not happening to you. You are in control of your business. You're in control of what's going on, and you need to start taking full responsibility for everything that's happening. Get rid of the victim mentality. Learn how to utilize good debt, learn how to analyze deals with debt, and learn how to maximize debt for your benefit. What was the next one? What else did I say today? Debt. Oh yeah, take risks. Oh, invest in yourself. Start investing in yourself. Invest in your business. Invest in things that are going to propel you forward. Whatever it is. Whenever you're saying yes to something, you're saying no to something else. So invest in those things and say yes to the things that are going to move you and your business forward. If you haven't gotten this, that's what the slides we were just showing. That's from this right here. You'll get a copy of the slides. You'll get the full 8-hour presentation walking through this workbook, teaching you how to invest in real estate. Invest in yourself. This thing's free. Comes with 5 free bonus courses. All you got to do is put in your address and pay for the shipping. It's $9.97. The printing of this thing costs more than $9.97. It's like over $600 worth of value you get for just paying for the shipping. It's free. We'll send it right to you. But invest in yourself and do something for yourself today that's going to propel you and your business forward. Take some sort of risk. Don't be risk adverse. Be smart about it. Don't just do anything under the sun, but make calculated decisions and take risks that are going to pay you based on, risking a little. They'll pay you a lot. If you want to learn more about everything we're doing here, send us a DM. Thank you, everybody, for joining today. Thank you to all you 10,000 plus YouTube subscribers. Everybody coming on 11